Today, we are going to talk about taxation when you invest in global public markets. How does taxation work? This is quite a concern to a lot of people because they do not want to get involved in more paperwork, headaches, and then getting into kind of a argument or differences with the income tax authorities. So, this session is very important. It helps you understand how this entire system works. I'll start with something very simple. India and the United States of America have entered into something called the Double Taxation Avoidance Agreement. Please Google it, you can find it there. Now, what does this DTAA say? Essentially, it says that you will be taxed only once and not twice. So let's take an example. Let us say you invested $10,000 in the US public markets. Over a period of time, they have grown to, let us say, $15,000. Then you sell the portfolio and bring it back. Now, this gain of $5,000 is a capital gain and it will be taxed not in the US but only in India. And I am underlining the word only. Why? Because under this double taxation avoidance agreement, United States says that you who are a resident of India is technically called a non-resident alien or NRA, and NRAs will not be taxed on capital gains in the US. So this entire $5,000 is a capital gain on which you have to pay capital gain tax as per Indian laws. So let us say that this is the period over which this has grown is more than 24 months. In that case, this $5,000 is a long-term capital gain on which you will be paying a long-term capital gain tax of 12.5%. That is it. If the period over which it has grown is less than 24 months, it will be classified as a short-term capital gain and it will be taxed at your applicable tax slab. So if you are taxed at 30%, it will be taxed at 30%. If you are taxed at 20%, it will be taxed at 20%. This is the first part. The second part is that assuming you get some dividend or interest, let us say you got a dividend of $100. In the US, you will face a withholding tax, which is nothing but a TDS, a withholding tax of 25%. Now that 25% of $100 is $25. So the US will withhold $25 and pay you $75. That $25 withholding tax certificate you can give to your chartered accountant in India, that when he is filing your return in India, he can claim an offset of this $25 which has already been paid. So again, no double taxation. These are the only two sources of capital gain or dividend or interest that you can have. There is no other way you can earn. And because these are the two things, these are the simplest ones. Now we have a detailed note on it. We'll be happy to send it to you in case you are interested. Now there's a third element. When you remit money from India, there is something called the tax collected at source if your remittance is more than 10 lakh rupees in one financial year. So from 1st April to 31st March is one financial year. In that period, if you remit more than 10 lakh rupees, there will be a tax collected at source at the rate of 20% if it is for investments. Again, let's take an example. Let us say you remit 15 lakh rupees in the financial year. So the first 10 lakh rupees, there is no TCS. On the remaining 5 lakh rupees, there is a 20% TCS, which is about 1 lakh rupees. So from your bank account, you will be debited 15 plus 1, i.e. 16 lakh rupees. Now this 1 lakh rupee of taxation is not really a tax, it is a TCS. It is essentially a cash flow problem. Let me tell you why I am saying that. If you are a salaried person, you can take the TCS certificate and give it to your employer who will reduce the next month's TDS for you. This is the law in India. If you are a self-employed person, you would be filing advance tax every quarter. Then you can claim this TCS that you've already paid in the next quarter. And the third one is in case you don't do either of them, then when you are filing your tax return next July, you can claim this as an offset. So TCS is essentially a cash flow problem. It is not in essence a tax. I hope this helps you understand if there is capital gain, if there is dividend, how will they be taxed, and when you send a remittance above 10 lakhs, how will that be taxed? I hope you find this useful. If you want to know more, if you want to explore the US public markets, we'll be happy to help you there. Please reach out to us at ShiftAltCapital.